Hey everyone, welcome back to Corporate Decoder, the place where we shine a light on what companies are really saying when they're not trying to sell you anything, but instead trying to get you to buy their shares through a rights offering that sounds like a fancy way to get you to buy more stock. Today we're diving into what BlackRock Multi-Sector Income Trust has to say in this prospectus supplement, which is basically a deep dive into a new plan they have to offer more of their shares to the public. We'll break down what this means for you, the investor, how they're planning to get new money, and what the numbers really tell us. First off, let's talk about how they manage their money and what costs are involved. BlackRock, the advisor to this trust, has agreed to waive some of their management fees. This sounds good, right? They're saying they'll waive fees on money invested in other BlackRock funds or exchange-traded products. But here's the catch. This waiver is only until June 30, 2027. It's like a temporary discount. They're also waiving fees on their own money market funds. This fee waiver agreement can be ended by the trust or a majority of shareholders with a 90-day notice, so it's not a permanent perk. Now let's get into how they use borrowed money or leverage. They're using something called reverse repurchase agreements. And as of now, this represents about 35.74% of their managed assets. The interest they're paying on this borrowed money is 530% annually. They remind us that this interest expense is a real cost for the trust. This leverage can boost returns when things go well, but it also makes things riskier. If their investments don't earn enough to cover the interest, the value of your shares could drop faster. Here's a snapshot of where the trust stood right before this whole offering was announced. The net asset value, or NAV, which is what the underlying investments are worth, was 14.51 Then per share, but the shares were actually trading on the New York Stock Exchange for 14.47. This means the shares were trading at a premium, a little bit higher than what their underlying assets were worth. It shows there was some demand for these shares. This whole document is about a rights offering. What does that mean? Well, the trust is giving its current shareholders, people who already own shares on a specific date, the chance to buy even more shares at a special price. They're issuing over 14 million new shares, and a special price, they're issuing over 14 million new shares. So if you owned shares on August 19th, you got one right for each share you owned. These rights are like coupons that let you buy more shares, and guess what? These rights themselves can be traded on the stock market under the symbol BIT. The deal is you can use 3 of these rights to buy 1 new share. If you don't have enough rights to make a full set of 3, you can still buy 1 share if you have fewer than 3 rights. They're also offering something called an oversubscription privilege, which means if you buy all the shares you're allowed to and some people don't use their rights, you might be able to buy even more. But this is subject to limits and might not happen. Here's the really interesting part for many people, the price you'll pay for these new shares. It's not a fixed price. They'll calculate a formula price which is 95% of the average stock price for the last 5 trading days, including the day the offering ends. But there's a safety net for you. If this formula price ends up being less than 90% of the trust net asset value on that final day, then the price you pay will be 90% of the trust net asset value on that final day. Then the price you pay will be 90% of the trust's net asset value on that final day. Then the price you pay will be 90% of the trust's net asset value on that final day. Then the price you pay will be 90% of the net asset value. This is designed to make sure you're buying at a discount to what the shares are actually worth. A huge plus here is that all the costs associated with this offering, like getting the word out and all the paperwork, are being paid by the advisor BlackRock, not by the trust or you, the shareholders. This is a big deal because it means the money raised will go directly into the trust's investments and won't be eaten up by offering costs. You have until September 9th to decide if you want to use your rights. Remember, this date could be extended. Now, let's talk about a potential conflict of interest. The advisor, BlackRock, makes money based on the total assets under management. So when they recommend a rights offering to bring in more money and increase those assets, they naturally make more money. It's not necessarily bad, but it's something to be aware of. Their incentive is to grow the trust's assets, and this offering helps them do that. Let's look at the cost of owning shares in this trust. As a percentage of the trust's assets, the management fees are 1.24%. Other expenses add another 3.02%, and interest on their borrowings adds 2.95%. So in total, before any fee waivers, the annual expenses are around 4.26%. Even with those fee waivers from the advisor, the total annual expenses still sit at 4.26%. This is because the fee waivers are specific to certain types of investments and don't cover all the trust expenses. They provide an example if you invested $1,000 and the trust return was 5% per year, you'd pay about $43 in expenses in the first year and $129 over 3 years and so on. It helps put those percentages into perspective for your investment. Let's look at how the trust's finances are structured. Before this offering, they had about 39.8 million shares and net assets of nearly 78 million dirhams, meaning a net asset value per share with $14.50. If this offering is fully subscribed, they'll have over 54 million shares and their net assets will jump to over $777 million. The net asset value per share would be slightly adjusted to around 14.2037. This shows a significant increase in the size of the trust. This is a crucial section for existing shareholders. If you don't participate in this rights offering, your ownership stake in the trust will become smaller. That's called dilution. Also, if the price you pay for these new shares is less than what the shares are actually worth on the day the offering ends, the value of your existing shares will also be diluted, meaning the net asset value per share will go down. I suggest that if you don't want to buy more shares, you should think about selling your rights. The money you get from selling them could help offset some of the dilution you might experience. However, they can't guarantee that these rights will be easily sold or have any value. This section talks about leverage again. They're saying that after this offering, their use of leverage will actually decrease from about 32.69% of managed assets down to about 26.80%. While leverage can increase gains, it also magnifies losses. It means the value of the shares can swing more wildly. They also warn that this offering could make the trading of their shares more volatile. More shareholders participating or selling could affect the share price. And there's a risk that not everyone will use their rights, meaning the offering might not be fully subscribed. This would affect how much money they raise and whether they achieve the benefits they're aiming for. On the tax front, they mentioned that the value of the rights you receive generally won't be taxed when you get them. Your tax situation depends on how you hold your shares and if you sell the rights or use them to buy more shares. The breakdown of how to calculate your cost basis for new shares and any gains or losses can get pretty complicated. They strongly advise talking to a tax advisor. This filing makes mention of legal counsel Wilkie Farr and Gallagher LLP and acknowledges their role in reviewing the legal aspects of this share offering. They're also stating that their full audited financial statements from the end of last year, 2024, are part of this document package. This means you can go back and look at their past performance in more detail. So what's the story here? BlackRock Multi-Sector Income Trust is trying to raise significant capital through a rights offering. They're offering existing shareholders a chance to buy more shares at a discount. This will increase the trust's overall assets, which benefits the advisor through higher management fees. The rights themselves are tradable, offering a way for shareholders to participate or exit. From a financial perspective, the trust is looking to grow. The key numbers to watch are the subscription price versus the net asset value. If the discount is significant, it could be a good opportunity for current shareholders to increase their holdings at a favorable price. However, the risk of dilution for those who don't participate is real. The fact that all offering expenses are covered by the advisor is a strong positive, as it means more of the raised capital goes directly to work for the trust. The trust strategy is to be a diversified closed-end fund focused on income and capital appreciation. This rights offering is a way to fuel that strategy and take advantage of what they see as attractive market opportunities. The leverage, while reduced after this offering, still adds a layer of risk. Overall, this seems like a calculated move to expand the trust's asset base. For existing shareholders, it's an opportunity to invest more, but they need to weigh the potential for dilution against the benefits of buying at a discount. For new investors, this document is part of a larger prospectus, and you'd want to consider the trust's overall investment strategy and risks before buying shares, whether through these rights or in the open market. What do you think about this rights offering and BlackRock strategy? Let us know in the comments below. If you found this breakdown helpful, give us a thumbs up and subscribe for more corporate financial deep dives. And don't forget to join our Discord community. The link is in the description. Thanks for watching, and we'll see you in the next video.